Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today we're diving into a report from Klotho Neurosciences, and trust me, it's not as sleepy as it sounds. It's about a company trying to keep its spot on the stock market, and you know what they say about trying. This is a Form 8K, a current report that companies file to announce major events. In this case, Klotho Neurosciences is telling the world about some back and forth with the Nasdaq stock exchange. Basically, they were told they weren't meeting certain requirements to stay listed on the Nasdaq, and now they've gotten a bit more time. The main point here is that Nasdaq, the stock market where Klotho shares are traded, had some concerns. Klotho wasn't meeting the requirements for the minimum value of its publicly traded shares and the overall value of its listed securities. Nasdaq gave them until February of this year to fix things. When they didn't, Nasdaq said, hey, you might get kicked off the exchange. Think of it like getting a warning from your landlord that you might be evicted if you don't pay rent. Klotho had received 2 letters in August saying they were not in compliance. These letters cited 2 problems. 1, the market value of their publicly held shares was too low. This means the total value of all the shares available for the public to trade wasn't high enough. 2, the overall market value of all their listed securities, meaning all their stock, was too low. When the company failed to regain compliance, they received a delisting notice in February. A delisting notice is like a formal warning that your stock will be removed from the exchange. It's not something a company wants to see because it can make investors nervous and the stock price may drop. To fight back, Klotho appealed this decision and requested a hearing. This is like going to court to argue your case. By requesting the hearing, they were able to temporarily stop their stock from being delisted until the hearing took place. The hearing happened in March. Now, the good news, or at least the less bad news, is that Nasdaq gave them an extension until August to get back in line. That's a few months from now, but there's a catch, or multiple catches. To keep that extension, Klotho has to hit certain goals along the way. If they fail to meet those goals, Nasdaq could change their mind and take away the extra time. Klotho Neurosciences has common stock and warrants traded on the Nasdaq under the symbols KALTO and KLTO respectively. Warrants give the holder the right to purchase the company's stock at a specific price within a certain time frame. They are often issued as part of a financing deal. Okay, so where does that leave Klotho? Let's break down what this all means. This extension is a lifeline, but it's not a guarantee. The company needs to make some serious progress quickly to convince Nasdaq that they're worth keeping around. One of the biggest risks is that if Klotho can't meet the milestones set by Nasdaq, they'll be delisted. That means their stock would no longer be traded on a major exchange, making it harder to raise money in the future. On the flip side, if Klotho can turn things around and meet Nasdaq's requirements, it would be a major win. It would show investors that the company is serious about its business and that it's capable of overcoming challenges. It's important to remember that companies in this situation are often under a lot of pressure. They need to make tough decisions about how to allocate resources, cut costs, and grow their business. This can be a stressful time for employees and investors alike. Ultimately, the fate of Klotho Neurosciences depends on their ability to execute their plan and deliver results. They need to show Nasdaq and the market that they're a company worth investing in. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, give us a like, leave a comment, and don't forget to subscribe for more insights into the world of business. Until next time.